What's up everybody, GenExDividendInvestor here. In this video I'll be telling you a sad story about a dividend investing friend of mine in hopes that you can learn from his unfortunate experience. So if you appreciate me creating free videos like this, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. I'm going to kick this off with a useful investing example I heard online, which shows that investing in the stock market has been a great way to build wealth over the long run, even if you're unlucky. Let's say we have 6 investors. Each one invests $2,000 a year into the S&P 500 for 20 years. Person number 1 is Lucky Larry the Amazing Market Timer, a guy who manages to invest his $2,000 at the lowest point of the S&P 500 every year for 2 decades. Person number 2 is Immediate Indiana, a guy who immediately invests the $2,000 the second he gets it, regardless of what the S&P 500 is at. Person number 3 is DCA Daryl, a guy who takes the $2,000 he gets, divides it into 12 equal portions of $166.66, and then he dollar cost average invests each of those amounts every month throughout the year. Person number 4 is Unlucky Ulrich, the worst market timer, who invests his $2,000 unfortunately at the highest point of the S&P 500 each year. Person number 5 is T-Bill Terry, who is too worried to invest in the stock market because he can't bear to see his portfolio go down, so instead he puts his $2,000 every year into treasury bills. And finally, person number 6 is Cash Carson, someone that is too worried to invest in anything and just holds cash. So how do you think they all did after 20 years? Well, Lucky Larry, who magically timed the market and invested at the low point every year, ends up on top of everyone at the 20-year mark with a portfolio worth $150,000. Awesome. All you need is a crystal ball and you too can be Lucky Larry. Next best was Immediate Indiana, who invested his $2,000 as soon as he got the cash, and he ended up at a cool $135,000. Right behind him was DCA Daryl, who methodically invested each month throughout the year and ended up only a step behind Immediate Indiana with a final grand total portfolio worth $134,000. Then a bit behind him was Unlucky Ulrich, who also magically timed the market but was cursed and unfortunately invested at the worst point of the S&P 500 each year, but he still managed to end at $121,000. Not bad. Then we have T-Bill Terry, who didn't want to take on the risks of investing in stocks, so he went with treasury bills to get a bit of a return, and he ended up at $44,000. And finally we have Cash Carson, who ended at $40,000 of cash, i.e. 20 years at $2,000 a year. Note, this example didn't factor in inflation, and I didn't personally verify the numbers. But what we see is that even the unluckiest index investor of them all, aka Unlucky Ulrich, still ended up doing way better than the people who stayed out of stocks altogether. History shows us that index investing beats sitting in cash, and even investing at bad times has beaten out not investing over long periods of time. Of course, in the short term anything can happen, and there's no guarantee that the future will perform similarly to the past. If I was sitting on a big pile of cash and had never invested, then I would probably be a DCA Daryl, and honestly I might even DCA my lump sum over more than 12 months, depending on how much cash we're talking about, and I'd be ready to invest more if things crashed as I DCA'd in. History has shown us that statistically lump sum investing tends to beat out dollar cost averaging, but I'd probably still just DCA in if I'd never previously invested. Some people I talk to that have never invested are understandably scared about starting and then seeing their portfolio drop, especially at these all-time market highs. I get it, and it's normal to feel that way. But if you can't overcome your fears, you may end up like Cash Carson. Anyways, if I had to name which of those people that I'm most like, then I'd have to say Immediate Indiana, because as soon as I get cash, I invest it. But what I do differently than him is that I calculate intrinsic values for my stocks, and I tend to only invest in companies with a margin of safety, i.e. when they're cheap, which over time can be an advantage over DCA investing in the S&P 500. Like, I recently took a position in BTI in cash I got from selling some non-dividend stocks I made some gains on. If I were a better investor, I'd probably have a cash pile on the side, ready to invest when things crash. But I'm happy walking my own investing path that works for my needs and goals. Beyond my investments needing to be cheap, I also want ones with decent financial metrics, trends, and future prospects, and ones that align to how I want to build my diversified portfolio. And even though I do that, I still recommend that most people simply dollar cost average into inexpensive broad market ETFs. However, if you're willing to do your research and educate yourself and you can stomach the risks, then individual stocks in a diversified portfolio can probably also work out for you over longer periods of time. Of course, are we going to have a stock market crash? I'd guess yes. Will it happen soon? Maybe. Honestly, no one knows, and even savvy and successful financial investors make mistakes. Take Michael Burry, the investor who predicted the stock market crash of 2008 and who made billions by betting against subprime mortgages during the financial meltdown, which was so amazing that they made a movie about him. But he also shorted Tesla, which kept shooting higher and higher until he took it in his shorts enough that he got out. Was that his only mistake? No, because last February Burry said the market was on the brink of collapse. But 12 months later it still hasn't crashed, and in fact it's gone up another 15%. Again, will the market crash? Of course. Does anyone know when? No. What if some other famous financial people predicted? Well, in September, Robert Kiyosaki told a news outlet that the biggest crash in world history would hit in October. Did it? Nope. The S&P 500 not only didn't crash in November, it went up. Then it went up in December too. Now, don't get me wrong, both those guys are way more successful than I am. My point is merely that no one knows when things will crash, and it doesn't take a genius to say things will crash, because to me that's almost as obvious as saying the sun will come up tomorrow. But what is hard is to accurately predict crashes and then manage your portfolio so you benefit on the way down and on the way up. Which is why one of Lynch's famous quotes is, "Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves." But come on, is it really that hard to do? I mean, can't you just sit in cash and wait until the markets inevitably crash, then you invest, and then you get the honeys and you sail away in your yacht? Sounds good in theory, but it's very hard to pull off. And that brings us to my friend. He was one of the groomsmen in my wedding, and we talk almost every day. He's a smart guy, but he failed enough classes in college from partying too much that it took him 5 years to get a 4-year degree. He got an entry white-collar job outside his major. The guy never had a big salary or a job title or stock options or anything. But he loved investing. He took some courses at a local community college to learn about how to read balance sheets and stuff like that. He focused on dividend stocks in the 90s in companies like Con Ed and Lockheed Martin, as well as some tech stocks like Yahoo. He got married and had a kid and always lived frugally, which helped him drive his salary into the market. Before he hit 40, he realized he had enough dividend income coming in that he could retire from the rat race. So he did, and was actually my first and only friend who's retired and stayed retired for over a decade. Thus, I'd characterize him as a successful guy who's been investing for over 20 years. Which is why it surprised me when, at the end of 2019, he told me that he sold out of all his stocks and went into cash. The S&P 500 was around 3,200 at that time. Why did he do it? Well, for 2 reasons, he said. Number 1 was because he felt the markets were way too expensive. And number 2 was because the state of politics in the USA had gotten too crazy, and he was fearful for where things might go. I reminded him of Lynch's quote, but he felt things were just too out of whack for him to stay the course. What he didn't know at the time, and what turned out to be incredibly lucky timing for him, was that 3 months later the pandemic would rock the world and markets would crash. By March, the S&P 500 had fallen to 2,300. So think about my buddy. He's a seasoned investor, he sold everything at the top, he's got a ton of cash and the markets crash. Could you ask for a better pitch than that? So what does he do? Well, he waits. He feels he can't jump back in because the world is too unpredictable. Remember, it sounds easy to invest when you're sitting on cash and things crash, but it's not. In this case, the market started reversing and going back up. But why? Had the pandemic gotten better? No, it was still getting worse. So why was the market going up already? Well, the markets are irrational in the short term, and that often surprises people. Like, good news can come out for a company and its stock goes down, or bad news comes out and it goes back up. Anyways, since the market had started strongly going back up, I asked my friend if he was going to get back in. I mean, one of his big concerns about the market being way overpriced was no longer true. But he said that things were still too unpredictable for him to invest. As the market kept shooting up, I asked him what his plan was to get back in. He said he wanted to see 2 consecutive quarters of earnings beats before he'd jump back in. The S&P 500 kept rocketing up at a blistering pace, faster than anything in history. In the end of June, i.e. about 1 earnings report later, the market was back over 3,000 and was just 200 below where he got out. I again asked him if he's reconsidered, and again he says no. The market kept going up. In September, i.e. about 2 earnings reports later, the S&P 500 was around 3,300, so now it's 100 over the point he originally got out. I asked him if he was ready to get back into the markets given 2 solid earnings reports, but now he says he feels like analysts lowered their expectations due to the pandemic, making it easier for companies to beat earnings, So he wants to wait longer before investing to ensure more good news and the worst of the pandemic is behind us. Sidebar, when markets are shooting up, greed normally drives people to invest, and when markets are crashing, fear can often scare investors into panic selling. So now think about his mindset at that moment. He's understandably fearful about the pandemic. He's pissed that he missed out investing at the bottom, so he's feeling stressed out. He's even more pissed because the market is now higher than when he got out. And now he feels like the markets are too pricey again. And what happens? Well, the markets continue to run, and run, and run. Now here we are in January of 2022, and the S&P 500 is at 4582, and my buddy pulled completely out at 3200. That means he's lost out on 43% gains if he'd simply done nothing and not sold out. It also means he could have doubled his money in less than a year if he'd bought at the bottom of the crash. So unfortunately our dividend investor is sitting mostly on cash and using his principal to pay his bills. But hey, the market has to crash again, right? Sure, but when? Will it be today, tomorrow, next month, next year? I wish I knew. Ask yourself what you would do if you were in his shoes. It's easy to think you just buy after it crashes. How many days do you let it crash? Do you buy after one good day up? Do you wait for 5 good days up? Do you wait for one good earnings report? What do you do if you get back in and it keeps falling? Do you completely sell out again? Or maybe you have stop losses in place. Or maybe you've done some basic option strategies like bought in the money puts on equities index futures, or sold calls. Or maybe you've done more complex hedging straddles. Or maybe you're utilizing leveraged inverse ETFs to gain some downside protection. Whatever you do, you'll probably hear stories about investors who are playing the market brilliantly, and what you won't hear too much of are stories like my friends. Remember, you don't need to be a Lucky Larry to still do well over time. Just don't be a Cash Carson forever. I'm also not saying that buy and hold means you never sell. It's okay to sell if you calculate that things are way overpriced. Just be wary of quick decisions and your own fears and have a game plan to get back in if you get out. You don't have to be dogmatic about a buy and hold investing strategy, i.e. you don't have to take the phrase literally. Right now, more so than any other time in history, it's understandable to sell your overpriced assets. We're in extreme market conditions and I don't want you to be needlessly hurt without understanding the risks. Some really smart wealthy guys, like Elon and Jeff, have done some selling. And when the 2 richest guys in the world are unloading some stock, it's probably worth reflecting on your strategies. That doesn't necessarily mean changing them. I'm not selling and I'll ride through the crashes, but that doesn't mean you should. I've built a diverse portfolio of companies which I believe will continue to pay all my bills, even if we crash 50%. Also realize that you don't need to sell completely out. You could always just sell a bit of your stuff or whatever. Just think rationally about whatever you do in your portfolio. Speaking of portfolios, M1 Brokerage has a promotion running for a free $50 cash bonus for new users. The way it works is you click on my M1 referral link in the description of this video, and then either open a brokerage account and fund it with $100, or open a retirement account and fund it with $500. Then you need to keep your money inside the new account for 30 days from the date of deposit to get the free referral cash. Make sure to check the details out before you sign up to see what they're offering when you watch this video. Okay, now I'd like to shout out my latest new Patreon aristocrat who signed up since my last video. So thank you Phil M, aka Greg S, for signing up. Aristocrats gain access to my dividend spreadsheet product that I use in my videos, and they gain access to multiple private channels on my free Dividend Discord chat server, where I let my upper tier Patreons watch my videos before I release them to the public, as well as let them vote on which thumbnails I use for my videos, and of course they get more direct access to me. If you made it to this far in the video, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Finally, I highly recommend that you join my free Dividend Discord chat server, which has thousands of dividend investors on it and it's growing all the time. Thanks for watching, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.